Hello. Welcome back, friends, to Alpha Beta Soup, where we unpack Bitcoin using on-chain analysis. I'm TXMC. Well, today we've got several things to talk about. We'll be a little less focused on the price and technical analysis today. I want to talk about the Federal Reserve. I want to talk about the macro picture, and I want to show you some of the things happening on-chain. The last couple of videos have been a little more TA focused, and I feel like we've laid out our expectations in the technical side pretty well, and it's important to make sure we're also watching the other aspects of our toolbox to see that they're in alignment. So today we're going to talk about the Fed, and we're going to talk about on-chain. So I hope you're ready for that. If you enjoy my content, please give this video a thumbs up and subscribe to my channel. I appreciate all of your support, and we're almost at 7,500 subscribers. Incredible. And stay tuned near the end of the video. I've got a personal announcement that I want to share with all of you, so don't miss it. But I've rambled enough in the intro here, so let's get to the meat of it. So coming into yesterday, my priority was to watch the markets and see how they reacted to what Jerome Powell said. As the head of the Federal Reserve, his words have a huge weight on the market. And after they completed their monthly Federal Open Market Committee meeting yesterday, Jerome Powell held a press conference, released some comments, and answered questions. On a personal level, I find it ridiculous that the entire global financial system hinges upon the words of a handful of unelected people. This isn't the ideal way that markets operate, and it's kind of a farce that the whole financial system waits with bated breath once a month to see what Jerome Powell and his cohorts have decided our future will look like. But alas, that's the scenario we're in. And the general message coming out of the Fed meeting yesterday was that their plan is continuing on schedule. They will continue tapering asset purchases with an intent to complete in March, and we can expect a rate hike very soon after that. Now, based on the way Powell characterized the labor market, it seems that they, meaning the Fed governors and Jerome Powell, are of the impression that the economy is very strong, that wage growth is strong, that the labor market is where it needs to be because unemployment has been coming down. Now, many of us who are paying attention know that the unemployment rate is not in itself indicative of the health of the job market. There are a lot of individuals who are currently not seeking work, and so they don't show up as active participants seeking employment. They don't count in the unemployment rate. They are represented in the labor participation rate. So we know there are a lot of individuals not working, and that the amount of open jobs far exceeds the amount of individuals seeking work. And so from that perspective, the Fed feels that the job market is strong. And something they said yesterday repeatedly was that they felt that they had plenty of room to raise rates without affecting the job market. Now, the market itself interpreted that to mean that we would have at least 4 rate hikes this year. A couple of videos ago, I showed a tweet from Liz Ann Saunders that showed the estimated number of rate hikes the market was pricing in going into 2022. And the last time we looked at it, it was around here. It was around 4, a little over 4, which meant the market was expecting the Fed to raise the federal funds rate at least 4 times this year. That value has now spiked up to 4.6, closer toward 5. Jim Bianco, who's another economist I highly respect and follow, posted this tweet, which shows that market is now giving a 55% chance to seeing 5 rate hikes by the end of December. And they've given a 51% chance that we see a 6th hike in March. So the market is responding to the Fed with expectations of tightness, of the cost of money increasing and liquidity being pulled. Jim Bianco also mentioned over here that the S&P declined 3.5% while Jerome Powell was talking. So in a sense, they're starting to accept that the Fed is resolved in their intent to raise interest rates and reduce the balance sheet. Now, there's a couple of factors here that I think are worth mentioning. Now, because debt to GDP is so high, right now it's about 120%. The US has a severe imbalance of payments problem. Now, part of that is our privilege in being the world reserve currency. We have to run excessive account deficits with the rest of the world, and that gives us a balance of payments problem. And because the level of debt is so high, and because so much American wealth is now dependent on asset valuations, the The Fed is almost cornered in that they have got to allow inflation to continue running hot to pull down the levels of debt so that they can then enact normal policy measures like the reduction of the balance sheet. And I believe what Powell has signaled is that in March, after they complete their tapering of asset purchases, they intend to raise rates and then begin the process of reducing their balance sheet at the same time. I think that will be a policy error that could very well further pull down the markets. Debt levels are so high, and American wealth is so dependent on asset valuations at this point to sustain levels. If the Fed pulls liquidity from the market while also raising the cost of money at the same time that debt is this high, they're going to crash the markets and crush the middle class. That's my belief. Now, there's a lot of factors going into this, and I certainly am not a macroeconomist. I'm just a person trying to understand the world day to day. And it feels like we are heading towards a potential policy cliff for the Fed, where they have very little choices remaining to them that don't upset the markets. And as I mentioned in the last video, what I've thought Powell was doing for the last month is getting the market to de-risk itself. It needs the market to deleverage in a sense so that they can get back to normal policy. And the sooner the market does that on its own, the easier it will be for the Fed to navigate the wreckage, to figure out when to raise rates, how much to raise them, and when to do it in accordance with whatever their quantitative tightening plans are. And what we've seen in the last month is exactly what Powell needed to happen. Drawdowns across the market. And you can see those drawdowns here. From top left, we've got Bitcoin, the S&P 500, the Nasdaq, and the Dow Jones. All of them in 2022 are down considerably. This is not news to anyone watching this channel at this point. We also see that during this drawdown, during this pullback, some of these tickers have seen extremely high volume. If we look at the SPY, which is the spider ETF of the S&P 500, it had the highest volume that it had seen since March 2020 in the drawdown of last week. Same thing if we look at QQQ, which is the Nasdaq ETF. It had the highest volume since March 2020. And during this sell-off, what has really taken a beating have been tech and growth stocks, risk assets, for which Bitcoin is the prime asset. Look here at Netflix. It took a 20% haircut after hours last week on the highest volume since 2015. And the ARK fund, which is essentially the flagship for growth stocks in the equity markets, has been in a virtual free fall and has seen the highest volume this ETF has ever experienced in the last few days. This is showing a supreme deleveraging in the Western markets, and Bitcoin really helped to lead some of that drawdown. It was one of the first assets to show weakness back in November when things like Tesla were still ripping. And when we look here at the Bitcoin chart, it has caught some support at the top of this daily gap from the CME futures chart that we looked at together here. If I pull up the CME chart and I take off Coinbase, you can see there's a daily gap here from July. We talked about this in the previous video. The link is down below if you'd like to see that. And we anticipated that if we got to this gap, it would either provide support or we would see it filled. Well, it did get filled, but it also provided support. And we're now consolidating in a range here in the mid-30s. And in fact, if you look at all of the markets, they're all kind of consolidating in the area where they sold off. Now, it's possible that we see some support here and this helps to lead to a rally, but there's a lot of resistance ahead that will make the rally back up very perilous. And if I'm being honest about the price action, part of me feels that this move just isn't done yet. If we're going to experience a more than 50% drawdown without any relief rally to speak of, my gut feel about the market is that it needs to test the range low in order to assure conviction about that support. It doesn't feel normal to bleed this hard all the way down and then reverse without actually touching the bottom. Now, it's possible that there was volume front running this level. That might be partly why we were able to see a relief here. But unless that demand sustains itself, it's just going to fall back down because the macro environment is determining the general trend of all assets right now. Now, there's a couple of random altcoins that might be doing okay because they have their own individual catalysts driving unique adoption for them. But broadly, the market as a whole is going the way of Bitcoin and tech assets. Here's a look at our coin destruction dashboard. So as we've been pulling back and drawing down into this deep pit, what I've been looking at is profit realization on chain. And the reason it's important, as we've discussed many times now on this channel, realized profit spikes naturally occur at market highs because people are selling into market strength, they're realizing gains and profits, and everyone is in the green. Now, once we experienced the drawdown after the high in November, we saw a couple more smaller spikes on realized profit. These were people taking green before the market rolled over on them. And in the weeks since then, really since the beginning of December, realized profit has been extremely quiet. And the reason why that is important is because long-term holders, by and large, are in high levels of profit. The majority of long-term holders have coins from below 30,000. And as I'll show you in a moment, the long-term holder cost basis is down around 18,000. So many of them are in high levels of profit. And if we were seeing them exiting the market, if we were seeing their conviction shaken and their desire to leave manifesting itself, we would see spikes of realized profit. But instead, we're seeing it decline, dramatically decline. Now, there's a slight uptick here just in the last couple of days, but generally the value is very low from where it was for the past year or the past 6 months. Likewise, we are seeing a rise in realized losses. Some of this may seem intuitive. With price going down, naturally losses should be realized. But seeing spikes of realized losses and none of the people in profit taking profit really shows who is driving the market right now. Most of the coins being sold are from newer investors, which I may sound like a broken record at this point, but it's important to re-emphasize this when we observe it, that older hands are not spending. The spending we are seeing is mostly realized losses, not realized profit, and these hands have the newest coins. If we look at the spent profit ratio of short-term holders, it is well below break even, which is this solid black line across the middle. They have been realizing deeper and deeper losses into this drawdown. One of the dynamics about short-term holder spending that I want to point out here is that this is a bit of a bearish confluence with price. We see price reducing while short-term holder profitability spending is also reducing, setting lower highs and lower lows. If we look back at May through July of 2021, after we had the crash, short-term holder spending started setting higher lows from the bottom. And we had kind of a compressing effect where price was declining, but the profitability of short-term holders was getting closer and closer to break even before we finally popped out. This was an almost bullish divergence where price is declining, but profitability of shorter hands is getting better and better. Well, over on this side, in the most recent price action, basically since the beginning of October, we had an elevation of short-term holder profitability, but since the all-time high at the early part of November, they have been in a downtrend, a structural decline in profitability, and they haven't recovered. They're nowhere near recovering yet. And if we look at the spent profit ratio of the entire network, so not just short-term holders, but any coins that are moving, they are also underwater, solidly underwater. And the confluence between seeing this underwater and this underwater, while also knowing that long-term holder spending is still close to 2 because they are in profit, really shows that most of the spending going on these days is from short-term held coins. These two fractals look very similar to each other, and the long-term holder SOPR is just in kind of a slow, steady, sideways decline. Now, it's declining a little bit because long-term holders now own coins from this entire range in here. And so their profitability rating is now more in line with the current price, as the newest members of the long-term holder group have prices from March, April, May, all the way through probably to August now. So their total profitability rating, while still very high and their spending is still very profitable, it has come to a more manageable level from where their profitability was in the spring when they were highly incentivized to sell. And I'd like to show you what I mean by that comment. So the reason I say that long-term holders are less incentivized to spend here is twofold. The first being, based on historical trend, long-term holders by and large spend into market strength. They don't like to spend in weakness. They like to spend into market strength, and those times often coincide with high profitability for long-term holders. Look at this chart here in the lower center of the screen. This is long-term holder MVRV, which is the standing profit ratio of all long-term held coins. It's the ratio between the market cap and the realized price of long-term holders, the price at which they all moved their coins last. Now, the cost basis of long-term holders in January, February, and March was at 8x and 10x, which creates an immense incentive to spend coins into the market, to find exit liquidity, to pay yourself. And as we can see over here on long-term holder net position change, there was heavy distribution during this time of the year. Right here, this is where they were distributing when they had very, very high levels of profit, 6x, 8x, 10x. Well, after this distribution, and after spending a year ranging between 30 and 70K, long-term holders have slowly adopted more and more coins from these higher price levels. Remember, the cutoff for long-term holders is about 155 days ago. There is a smoothing function that makes sure it isn't a direct cutoff at 155 days, but it's basically 5 or 6 months, which would mean that the newest long-term holders acquired their coins in July or maybe early August. So many of the long-term holders are now holding coins from these prices, from prices near or even above where we are currently. Now, if you mix that in with all of the long-standing long-term holders with coins from before 2021, their collective MVRV, their total profitability rating of all long-term holders is a little more than 2 right now. It's about 2.1. So as a group, they're still heavily in the green. And when we see spending that is not showing profitability, but is mirroring the negative in-loss spending of the short-term holders, it tells us that they are the ones moving corn right now. In fact, long-term holders are adding to their stacks, which you can see in the screen here. Their supply is growing. It's now curling back up, which means that their spending is over and coins are aging into that group. In another sign of confidence for the market, we can look at exchange net flow volume, which is the net volume each day of coins deposited and withdrawn from exchanges. And if you look over here in the last couple of months, there's a lot of red prints on this chart. Yes, there are some moments where it pops up into the green and we see some small inflows, but the trend, the multi-month trend, is still predominantly outflows. And this is even with the known inflows to Binance that occurred in the last few months of 2021 that caused quite a bit of ruckus in the on-chain space. If we look at Binance specifically, we can see they had quite a bit of growth in the second half of last year. And as we explored on this channel before, my thesis about why this occurred was because China was shutting down a lot of exchanges in their territory. So places like Huobi and OKX were seeing outflows of their exchange balances at a similar clip to Binance's inflows. So I believe they adopted quite a bit of those traders. But if we look at the global exchange balance net flow, it's predominantly negative. Coins are being withdrawn from exchanges in net while price is reducing. So the kind of behavior that would give me pause here is if we saw spikes of net flow volume like we had here in May, where people are rushing to the exits to deposit coins onto the exchange. You see this regime right here where the net flow chart is predominantly positive. This is the kind of trend that would make me concerned in the pullback, but that's not the dynamic we see over here. This is really a tale of two corrections in a sense, where we had tons of panic selling, just a complete market dump here in April and May. Whereas now in November and December, it's more of a controlled demolition of price all the way down, led by a couple of liquidation events, but mostly just non-stop macro de-risking. I mentioned a moment ago that I would show you the long-term holder cost basis, and it's this dark blue line here, currently sitting around 17,500. That's what helps to produce the 2.1 level of profitability that we found long-term holders currently sitting in, because 17.5 times 2.1 is this price right here. So the long-term holder group, by and large, even though their cost basis rose significantly in 2021 as they absorbed coins in these higher prices, as they adopted new members of the group, their cost basis is still well below price, about half of current price. And I don't think that we would get down to this level in a wipeout. This seems like a very low level, and I would honestly be shocked to test 17K. But what I do think is more realistic, if we see further downside and de-risking, it's important to know that while 29,783 right here is the low of the past year, that's what this gray line is. It's the yearly minimum of price. While we have some support here at 29,000, if we break below this, the next value is 24,000, which is the realized price. Now, I'll leave a link down below to a deep dive a couple videos ago where we explored the realized price and how it has changed over the last couple of years. And it is what I would consider one of the strongest psychological on-chain supports. The realized price is the cost at which all coins last moved. So if we were to wick below 29,000, as Bitcoin doesn't usually respect levels cleanly, there's usually some volatility around support levels, we might wick down to 24,000. So I'm just keeping that in the back of my mind if we were to continue drifting down. If we got to 29,000, I would expect us to break below it. And just since we haven't talked about it yet today, I wanted to check in with the futures market. Here is our derivatives dashboard. At the top, we've got open interest specifically for the perpetual market. We can look at total open interest up here at the top, which is the entire market. And you can see it is still super elevated. It's basically near all-time highs going sideways. And the perpetual market is even more elevated relative to itself in the past year. But what has really got me intrigued in the last couple of days is the funding rate. The funding rate has finally carved out a sustained discount regime, which is something I was hoping to see. Now, the funding rate is a measure of the bias in futures. It can help you to get a sense of who is pushing the aggression in that market. Is it the shorts or the longs? When the funding rate is positive, then longs are paying a premium to the shorts to keep their position open. When the funding is negative, it's flipped. People who are going short, meaning they're betting on price to go down, to go lower, those people are paying a premium to the longs, and it's incentivizing long traders to take the counter of the bet. Now, when we see a sustained discount regime, most of the time, if it happens while we also have very high open interest and it's not immediately after a flush, it's usually indicative of aggressive shorting. Now, sometimes the funding rate, like it did over here in December 4th, can just plummet negative. And that can happen when we get a quick move to the downside. The momentum of sell orders from long liquidations push the futures index so far below the spot price that it creates this negative funding. And you can see it just whips right back up. But over here, this is sustained negative funding. And this is exactly what I want to see. I want to see sustained negative funding with high open interest down here at the lows. Now, if we get another wick down, some of these traders will be right and they will profit from this. But zoom out a little bit. Don't just think about the next week. Think about what this could do a month from now if this continues to grind and build and build. If I zoom out and go look at last summer, this is a sustained negative funding regime. For multiple months, sustained negative funding, and it led to ultimately a violent short squeeze that started here in July. It started right here when you see prices zipping up on July 26th, and that helped bounce us out of the June-July bottoms. So this funding rate is great. It's a good start. It'd be great to see it continue to stay negative, maybe even go more negative, and really show the world how aggressive these bears are. Let people see how they think Bitcoin is going to go lower, and let it return some conviction to these bulls. Bulls need to show the market what they're made of here. Because as we've explored, the actual holders of Bitcoin don't care at all about this price action. They're not spending here. In fact, they're most likely buying the dip, because if they're not spending and we see coin maturation from groups that are normally active at key points in the market, the likely assumption then is they're probably standing pat or buying the dip. And while we've got that behavior going on, and we see that the majority of the spending is coming from newer hands who are spending in a loss, while long-term holders are not really doing anything. Their spending and their profitability has stayed about the same, and their supply is actually growing here. We can say that the majority of spending are newer hands. And they continually capitulate while we're building what appears to be the criteria that would make a short squeeze very possible. But again, that short squeeze would need to happen from bulls showing some strength. Price would actually need to move up for this to happen. And all we've seen for over 2 months now is downward sideways price action. So it's a lot to ask of the current market to show strength and to reverse. And it might not be ready to do that, which is why we have to stay realistic and balanced in our approach. So we think that maybe there's a short squeeze building. It's a little too early to say, but we've been watching these dynamics play out for several weeks. We've been watching OI build and build and build into price weakness. We've seen some longs getting liquidated, but not that many. And now that we have a negative funding regime, I'm really starting to feel that a short squeeze is possible. It's hard to call for one of those things because a lot of factors have to align to make it happen, but the criteria are there and it's becoming a little more obvious than it was before. Now, the very last thing I will show today, because I know I've talked about a lot of things, is illiquid supply. I get requested to show this chart fairly often, and I don't want to disappoint. Here in blue is illiquid supply, and we have been watching this for all year long. Illiquid supply represent the hodlers. They represent individuals on chain that have a low spending history. They're predominantly inflows. And the illiquid supply is continuing its march upwards. It's not showing the same kind of weakness that it showed back here in March and April when we had a true market meltdown. We've had a similar drawdown, but it's been much more of a stepwise and drawn out process, and it's occurred while illiquid supply has continued to march upwards, which helps to reinforce my general belief of a supply squeeze. We did get one that started back here in July and carried us all the way up into October. This is what we talked about early on in my channel when we were making videos back in September, was a supply squeeze situation helping to carry the rally. But because demand never came in, retail never showed up. The rally ran out of steam and rolled over. But the entities who started the supply squeeze have not changed their behavior. All that's changed is that the macro picture has become far more uncertain. Bitcoin itself has done very little. In fact, it's just become more bullish. There's more countries talking about adopting it as legal tender. Hash rate recently hit an all-time high, which means miners are continuing to bring more machines online. And we're seeing more and more institutional adoption. There are a lot of very bullish things going on for Bitcoin broadly, but because of what's happening in the Western markets, as we explored early in the video, because of the general de-risking climate going on globally, Bitcoin is taking it on the nose. But it's taking it on the nose mostly from the newest holders of coins and from people in the derivatives market, from mostly futures. They're the ones driving the price, while the hodlers just keep on stacking. You see these green bars? This is showing inflows to illiquid supply day after day after day after day after day. There's only 4 red bars on this chart going back to October. Pretty remarkable. There's one personal note I want to fit into the video here before we wrap up today. I tweeted out 2 days ago that I have officially parted ways with Glassnode. It was a mutual, amicable separation. I wish those guys nothing but the best. They're an absolute class organization, and I think that they are the best data team in crypto, bar none. I love working with them, and I enjoyed working for them the last few months. But on a personal note, we just had different visions of the next year. They have a specific vision that they're trying to go forward with. There's some work that they want to do and some content they'd like to produce. And I just didn't feel that I was the right person to see that vision through. And the reason is because of this channel. Since I started this journey in September, I have discovered a deep, true passion for learning about the markets, learning about Bitcoin, and then discussing it with all of you. It's what gets me out of bed every day. It's what I think about nonstop. I'm constantly pushing myself to come up with new topics, with new angles to discuss with you, to unpack, to dive into. And I just don't want anything to take me away from putting all of my energy into this effort. Now, one could say that working for Glassnode would involve learning about the markets and talking about it with all of you, but there's something special about owning the process and owning your own brand. And I didn't understand how important this would become for me when I started on this journey, but I am so grateful that I have discovered it because now this is all I want to do. By going my own way from Glassnode, I'm betting on myself. So it's a gamble, but it's one that I have high confidence in because I feel happy and I feel motivated to do this. So we will continue making videos together. We'll continue exploring the data. Nothing is going to change except that my day will be more freed up to focus on my content. So that's what I wanted to talk about today. We covered a lot of things. The Western markets are de-risking while Jerome Powell prepares them for rate hikes in the near future, as soon as possibly March. The Fed also has signaled that they intend to reduce their balance sheet, which I suspect will be a policy error that could have major negative implications for the markets and for the working class. I believe that the debt levels are too high and that the Fed needs to let inflation run hot in order to bring debt to GDP down and allow them to enact normal policy measures without tipping the markets over. While all this is happening, while Bitcoin was selling off and the greater markets were selling off, long-term holders were doing little to nothing. There's minimal spending by old hands. Illiquid supply continues to grow, and short-term holders find themselves deeper and deeper in loss. It does appear that criteria are in place for a short squeeze to occur in the futures market, but it won't begin without actual demand in the market to push price up and catalyze the squeeze. If we continue seeing consolidation and maybe further downside, those shorts will be rewarded and the squeeze will not play out. But seeing a sustained negative funding regime is a positive for people who want price to go up. Make sure you're following me here on Twitter at TXMCTrades. I post a lot of charts, I post analysis, I posted my announcement about Glassnode. I also answer questions and comment on other people's posts, so it's a good place to interact with me. Today, I'll be testing my software, and if it works, I intend to do a live stream sometime this weekend. Maybe Saturday's the best day for it. I'll send out an announcement tomorrow if I get everything worked out so people can be ready for it, and then maybe we can chit-chat some this Saturday and do some live discussion. I just need to get my streaming software working. But all right, I've been talking for a long time. I gave you a bunch of things to digest, and I know when it's time to wrap up the video. So we'll let things play out for a couple of days. I'll produce another long form video, maybe at the end of the weekend or on Monday, and we'll look to maybe do a live stream on Saturday if technology cooperates. I hope you're having a great week. I hope that through our discussions, the things that are happening in the market are less of a surprise to you and that you feel more prepared to interpret and weather the storm. If you have any questions for me or feedback about the content, please leave it in the comments below and I will read through it. That's about it today, friends. Hopefully we'll get to chat here very soon in a live environment. That'll be a lot of fun. And if you missed that, keep an eye out for the next produced video in a few days. But that's all for me. Until we speak again, take care of yourselves, friends. Cheers.